Welcome back, deep divers. Today, we're going to plunge headfirst into the world of the Federal Reserve.
The Fed.
Yeah, the Fed. That mysterious institution that seems to have its hands in just about everything in our economy.
It does.
But how much do we really know about it, and how do its decisions actually impact, our everyday lives?
That's a great question.
Like, does it really affect the price of milk? Or how much we pay for a house?
It can.
Seriously. Okay, so today we're on a mission to demystify the Fed, figure out how it wields its power, and explore how a system designed to, keep our economy stable might actually be causing some of its biggest problems.
And to guide us on this journey, we're going to be using Christopher Leonard's book, The Lords of Easy Money, How the Federal Reserve Broke the American Economy.
Ooh, catchy title.
It is.
So what's the book all about?
It's a deep dive into the Fed's pursuit of easy money policies and the unintended consequences that have followed.
Consequences like what?
Well, we're talking things like asset bubbles, rising inequality, maybe even political turmoil.
Yikes. That sounds pretty intense.
It is a pretty thought-provoking read.
Okay, so where do we even begin with all of this?
The story really revolves around this fascinating figure, Thomas Hoenig, a longtime Fed insider who wasn't afraid to challenge the status quo.
Okay, wait, a Fed insider, like one of those guys in a suit who always seems to be talking in riddles?
Well, Hoenig is an economist, but his background is anything but typical. Before the Fed, he was an artillery fire control specialist in Vietnam.
Whoa, really? So, like, calculating missile trajectories and stuff?
Precisely.
I guess that kind of makes sense. A monetary policy is all about making these really fine-tuned adjustments, right?
It is. And for Hoenig, understanding the consequences of those adjustments, the ripple effects, that came from his experience in Vietnam.
Making a mistake with a missile launch, that has some pretty serious consequences.
Absolutely. And that caution, that deep understanding of cause and effect, it really shaped his approach to monetary policy when he joined the Fed.
So he's not just some ivory tower academic. He's seen the real-world impact of, bad decisions.
Exactly. And when he landed at the Kansas City Fed, he witnessed the devastating effects of runaway inflation and bank failures of the 70s and 80s.
Ah, the ghost of financial crises past.
Yeah. There's this great anecdote in the book. When Hoenig became president of the Kansas City Fed, a neighbor gave him a gift.
What, like a fruit basket?
It was a framed piece of hyperinflated German currency from the 1920s.
Wow. Okay, talk about a conversation starter. What was the neighbor trying to say with that?
It was a stark reminder of what can happen when a central bank loses control of its printing press.
Okay, I'm starting to get the chills here. Like, this wasn't just an academic exercise for Hoenig. He'd seen the damage that bad monetary policy can inflict on people's lives.
And that fear of repeating the mistakes of the past, especially the great inflation of the 1970s, it really drove Fed policy for decades.
Okay, so the Fed was obsessed with keeping prices stable. But Leonard argues that they might have missed a bigger problem brewing in the asset markets, right?
That's right. They focused so much on controlling price inflation that they neglected asset inflation.
Okay, hold up. Can you remind me what the difference is between those two again?
Sure. Price inflation is what we typically think of as inflation, the rising cost of everyday things like groceries or gas.
Got it. Like when that carton of milk keeps getting more expensive.
Exactly. Asset inflation, on the other hand, is the rising prices of things like stocks, real estate, bonds.
So like the housing market going crazy.
Exactly.
So the Fed was so busy keeping milk prices in check that they might have missed a ticking time bomb in the stock and housing markets.
That's essentially what Leonard argues. And that brings us to the era of Alan Greenspan. He took the helm of the Fed in the late 80s and became this, almost mythical figure in finance.
Yeah, Greenspan, he was a master of, cryptic pronouncements.
Right. People would hang on his every word, trying to decipher what the Fed was going to do next.
So, like a financial oracle.
Kinda.
Mm.
Leonard calls it Fed speak. And he argues that while it might have made Greenspan seem all-knowing, it also obscured a lot of what was happening in the markets.
So like a smoke screen.
In a way.
Mm-hmm.
And this lack of transparency, it could have made it easier for those asset bubbles to form under Greenspan's watch.
Like the dot-com bubble in the late 90s.
Exactly. Everyone was throwing money at anything with a .com in its name.
Oh, yeah, I remember that. It was a gold rush for internet companies.
It was. And while Greenspan deserves some credit for, overseeing a period of economic growth, his policies, especially his lowering of interest rates, they played a role and inflating that bubble.
So, too much easy money, not enough oversight.
That's one way to put it. And it's around this time that our main character, Thomas Hoenig, starts to sound the alarm.
He wasn't buying into the hype.
No, he was worried about the consequences of all that easy money floating around. He saw the potential for things to go very wrong. And he even cast his first dissenting vote against Greenspan's rate cuts.
Wow, a dissenting vote. That's got to be, like, unheard of at the Fed, right?
It is very rare. The Fed usually tries to present a united front. But Hoenig wasn't afraid to speak his mind, even if it meant going against the grain.
He was like the lone voice of reason in a room full of cheerleaders.
He was definitely raising red flags. And his dissent highlighted this growing tension within the Fed, this tension between those who believed in the power of what's called the Fed put and those who saw it as a recipe for disaster.
Hold on, the Fed put. What's that? Sounds like some kind of financial jargon.
It is a bit jargony. Think of it as this, like implicit guarantee from the Fed that they'll always step in to save the markets if things start to crash.
So like a safety net for investors.
Yeah, basically.
Yep.
And it can lead to, some moral hazard.
Moral hazard.
Yeah, if investors believe the Fed will always bail them out, they're more likely to take bigger risks.
Because they know they won't face the full consequences if things go south.
Right. And that can lead to, more bubbles and more instability in the long run.
Okay. I'm starting to see how this all connects. Easy money, moral hazard, asset bubbles. It's a recipe for trouble. And this brings us to the early 2000s and, of course, the housing bubble.
Right. Think back to those years. Low interest rates, lax lending standards, these complex financial instruments like mortgage-backed securities. It was, as they say, the perfect storm.
Yeah, it felt like everyone and their grandma was getting a mortgage back then, even if they couldn't really afford it.
And the Fed, under Greenspan's successor, Ben Bernanke, they continued these policies that, kept those easy money spigots flowing.
And this is where those seeds of risky debt and inflated asset prices that Hoenig warned about, they really started to sprout, right?
Yeah, unfortunately. And when the housing market finally collapsed in 2008, it triggered a financial meltdown that sent shockwaves across the globe.
Oh man, 2008. That was a scary time. Banks were failing, the stock market was plummeting. It felt like the whole system was about to implode.
It was definitely a crisis moment. And to prevent a complete collapse, the Fed took unprecedented action. They pumped trillions of dollars into the financial system through a program called quantitative easing.
Quantitative easing, or QE. We hear that term thrown around a lot, but what does it actually mean?
Well, imagine the Fed has a magic money printing press.
Okay, I'm listening.
With QE, they basically create new money out of thin air and use it to buy bonds from banks.
So they're just like injecting money into the system.
Exactly, flooding it with liquidity. The idea is to encourage lending, lower interest rates, and boost the economy.
But didn't Hoenig, our lone wolf at the Fed, vehemently oppose QE?
He did. He argued that it would just create more asset bubbles, distort markets, and trap the Fed in a quagmire of easy money policies that would be almost impossible to escape.
So he was basically saying, hey, you're kicking the can down the road, and it's going to come back to bite us.
That was essentially his message. But the Fed, they focused on preventing a total economic meltdown. The long-term consequences of QE took a backseat at that moment.
It's like they were choosing the lesser of two evils.
You can see it that way. And this leads us to the aftermath of the crisis, where the Fed implemented what's known as the ZRP regime.
ZRRP. Okay, now you're just making up words. What is ZRRP?
It stands for zero interest rate policy. Basically, the Fed kept interest rates near zero for years after the crisis.
I see. So borrowing money was basically free.
Pretty much. The goal was to encourage borrowing and spending, to get the economy moving again.
Sounds good in theory, but I'm guessing there were some unintended consequences.
There were. One big one was that it incentivized investors to search for higher returns in riskier assets.
Because those safe, boring investments like bonds were offering practically no return.
Exactly. So even if you were being cautious with your money, you were almost forced to take on more risk to get any kind of decent return.
Okay, I'm starting to see how this whole easy money thing can create a bit of a vicious cycle.
It can. And to illustrate how this played out in the real world, Leonard brings in the story of Rexnord. It's a Milwaukee-based manufacturing company.
Okay, I'm intrigued. Tell me more about Rexnord and how they fit into all of this.
Okay, so Rexnord Manufacturing Company, what's their story and how do they fit into this whole Fed saga?
Well, Rexnord is kind of a microcosm of how easy money can fuel, let's say not so great corporate behavior.
Okay, I'm listening.
So with interest rates so low, private equity firms, they had tons of cash to throw around.
Okay.
And they saw Rexnord as, like, ripe for the picking.
Ripe for the picking, meaning
Well, they swooped in, bought the company, loaded it up with even more debt.
more debt. Why would they do that?
And then they extracted profits through things like dividends and stock buybacks.
Hold on, stock buybacks. Isn't that just like a way to boost the stock price and benefit shareholders? How does that help the average worker at Rexnord? It often doesn't. And that's a big criticism of this kind of financial engineering,
Yeah.
Instead of investing in the company's long-term growth, creating jobs, maybe increasing wages,
Right.
the money just gets funneled back to investors.
And this all happened, like, under the Fed's watch. It seems like they were creating the conditions for this kind of behavior without even realizing it.
That's a big part of Leonard's argument.
Yeah.
He says the Fed was so focused on price stability, they were almost blind to the risks building up in the financial system.
Like they had blinders on.
Yeah, exactly. They were so worried about deflation, they didn't see these asset bubbles inflating right in front of them.
It's like they were trying to put out a fire with gasoline. They thought they were stimulating the economy, but they were actually fueling the next crisis.
That's a good way to put it. And it's interesting because remember Jay Powell, the current Fed chair?
Yeah.
Well, before joining the Fed, he worked at Carlyle Group.
Carlyle Group.
It was one of the private equity firms involved in that whole Rexnord saga.
Oh, wow. Really? That's a pretty interesting connection. So the guy in charge of the Fed now used to work for a firm that profited from the very policies he's now overseeing.
It definitely raises some questions.
Yeah, about conflicts of interest and whether the Fed truly gets the real-world impact of its decisions.
Yeah.
Okay, so we've got easy money, rising asset prices, private equity going wild. Where does all this lead?
To what Leonard calls the everything bubble.
The everything bubble.
Yeah. By the late 2010s, asset prices across the board, stocks, bonds, real estate, they were inflated to levels that seemed, well, unsustainable.
It's like the whole financial system was built on a house of cards.
Pretty much. And of course, bubbles always burst eventually.
So what popped this one?
Well, in 2019, a critical part of the financial system, the repo market, experienced a sudden meltdown.
The repo market. Remind me what that is again. I'm not exactly a Wall Street guru.
So think of it as this short-term lending market, where banks and other institutions, they borrow and lend cash using treasury bonds as collateral. It's usually pretty stable, very liquid. But in 2019, things went haywire.
What happened?
Basically, there was a shortage of reserves in the banking system,
Okay.
and that led to a spike in interest rates. Banks got nervous. They didn't want to lend to each other. They were afraid they wouldn't get their money back.
So it was like a sudden freeze in the system.
Exactly. A classic liquidity crunch.
Yeah.
And it forced the Fed to intervene. Big time.
Really? They had to step in and bail out this, what was called repo market.
They did. They pumped billions of dollars into the market to stabilize things. And it was a sign,
A sign of what?
a sign that even though the economy seemed to be doing well on the surface, under the surface, there were these cracks starting to show.
Cracks in the foundation.
Yeah. And then, boom, the pandemic hit.
Oh, yeah, 2020. The world turned upside down.
It did. And the Fed, they responded with even more force than they did during the 2008 crisis.
Really?
They slashed interest rates back down to zero, launched new QE programs, worked with the Treasury to backstop corporate debt markets.
So they basically threw everything they had at the problem.
It was unprecedented.
Yeah.
They were trying to prevent a complete financial collapse.
I remember those early days of the pandemic. It felt like the world was ending and the Fed was the only thing holding it together.
It was definitely a chaotic time. But Leonard points out that this massive intervention also raised some serious questions.
Questions about?
About fairness.
Yeah.
About long-term consequences.
Like what?
Well, for one, a lot of the benefits of all this easy money, it seemed to flow mostly to those at the top.
The wealthy, corporations.
Exactly. While a lot of ordinary Americans, they were struggling to just stay afloat.
So the stock market was booming while Main Street was suffering.
That's the irony. And it brings us back to Rexnord, the company we talked about earlier.
Okay.
Leonard highlights this worker, John Feltner.
John Feltner.
He lost his job when Rexnord moved its operations overseas. And this was despite the company receiving government assistance and benefiting from the Fed's easy money policies.
So the very policies meant to help the economy were indirectly contributing to job losses like Feltner's.
It's a tough pill to swallow. And it shows that the Fed's actions have real human consequences.
Yeah, consequences that aren't always evenly distributed.
Right.
So where do we go from here? Is the Fed just stuck in this cycle of easy money, asset bubbles, and bailouts. Is there any way out of this mess?
That is the big question. And Leonard, he doesn't offer any easy answers,
Oh, great.
but he does suggest some potential solutions, things we could try to, break the cycle.
Okay, I'm all ears. What does he propose? So spill the beans. What are Leonard's solutions? What can we do to fix this crazy system?
Well, one of his big ideas is we need to rethink the Fed's mandate.
Okay,
Like right now, their focus is almost entirely on price inflation.
right. Keeping prices stable.
But Leonard says we need to acknowledge the dangers of asset inflation too.
That makes sense, because if you're constantly trying to pump the brakes on price inflation, it's almost like you're pushing that air into the asset bubble balloon.
Exactly. It's like squeezing one end of a balloon, the air just shifts to the other side. You can't just ignore one type of inflation and expect everything to be fine.
So the Fed needs a more balanced approach. What else?
He also argues for stricter regulations on those big banks,
Hmm.
the ones that are too big to fail.
Ah, those guys.
They've benefited enormously from these easy money policies, but when they make risky bets and lose, it's often the taxpayers who end up bailing them out.
It's like heads they win, tails we lose. Not exactly a fair system.
Right. And then finally, Leonard is a huge proponent of transparency.
Transparency.
Yeah. He thinks the Fed needs to be way more open about their decision-making process.
Because right now it's kind of like a black box, right?
It is. All this secrecy, the jargon, it makes it hard for the public to understand what they're doing and why.
Makes you wonder what they're hiding.
Well, Leonard believes they need to be more accountable to the public, more responsive to the needs of the real economy, not just Wall Street.
So less secrecy, more accountability.
Exactly. And these are just a few of his ideas. But his book really gets you thinking. It challenges a lot of the assumptions we have about how the financial system works and how it should work.
It's a wake-up call for sure.
It is. It makes you realize that we can't just sit back and let these lords of easy money control our economic destinies.
So what can we do? Like as individuals, how can we make a difference?
Well, first and foremost, we got to stay informed.
Educate ourselves.
Exactly. The more we understand how the Fed works, how their policies affect our lives, the better equipped we are to demand change.
And hold them accountable for their decisions.
Right. And we got to talk about these issues, have conversations with our friends, family, elected officials.
Get the word out.
Yeah, because at the end of the day, the decisions made in those ivory towers, they affect all of us.
So we need to make our voices heard.
We do. And I think that's really the biggest takeaway from this deep dive. It's not just about understanding some complex economic theories. It's about understanding our own power, our own role in shaping a better economic future.
So to all our listeners out there, stay curious, keep asking those tough questions, and remember, we're all in this together.
Thanks for joining us on this deep dive. We hope it's given you some food for thought.
And until next time, keep diving deep.